G'day expats and welcome to another episode of Expat Chat, episode number 54 today, and joined by my esteemed colleague and mentor and all advice of what's going on good back in Oz, James Ridley, my business partner who runs the Australian office and manages clients in the Asia and Americas region. G'day James.
G'day, Brett, and ladies and gentlemen who are dialing in today, as always, joined by Brett Evans, the Managing and Founding Director of Atlas Wealth Management, and now looks after, I should say, the EMEA region, which stands for Europe, Middle East and Africas. Obviously an expert in that region, and rumours are that I might be joining you over there for a brief trip in the future. See what the June bugging is like again. But mate, how are you going? How's the sandpit? How's it treating you today? Any expats left there, or have they all fled the heat?
Mate, I think Dubai had its busiest day recently when school finished. Passenger numbers, like we're talking lots.
Yeah.
But you know, luckily this region is not experiencing the same problems that Europe's experiencing. You know, when you see pictures out of Heathrow with baggage and all sorts of stuff everywhere.
Oh yeah, chaos.
It's just chaos. You know, and there's apparently just something like 10,000 seats were just recently cancelled by British Airways. You know, so you booked a flight, ready for your holiday, your flight's just gone. So certainly not experiencing that, which is good. This place they were pretty aggressive in hiring late last year. So, you know, to their credit, they've managed it well. And hopefully, everyone has a good, well-deserved holiday because it's been a crazy 12 months. And mate, I think what we wanted to talk about today was, you know, there's been a lot of talk about recessions, bear markets, and technically we are through a bear market in the US, I will say, not an Australian market, but in the US, it's any contraction greater than 20%. So what turns a bear market into a bull market? You know, that's what we want to talk about today, because people are, you know, coming to us and saying, hey, look, I'm good with all this risk and volatility and stuff, but is now the time? And should we be coming into it? So, mate, let's jump into this episode. It's a pretty cool one. Just for an disclaimer out there, all information that you are about to listen to, receive and infuse by osmosis is to be used as educational, informational purposes only. Please do not pursue this as personal financial advice. Please speak to a professional like Atlas Wealth Management.
Absolutely, man. And listen, great topic, because yes, not all share markets around the world are in a bear market. Right now, you hit it on the head. It's actually just, I suppose, the US index. I honestly don't believe Australia will get anywhere near a bear market. Where our local market, we're very different to the US share market. But it's a really good question in terms of, okay, well, what is a good indicator, or what turns a bear and moves a bear over and transitions it into a bull market? Because no one really has that crystal ball, but I think there are things we can look at that might be a precursor into sometimes, you know, when the market's starting to turn. You know, a good precursor that is coming about, earnings season. It's going to give us a really good insight into how companies perform for the first 6 months. And the first 6 months of this year is what has brought that bear market on the S&P 500, the NASDAQ 100. But that could turn very quickly when you look at earning results and you're like, oh, hang on, all these companies, they're doing great.
They're still earning the same amount. Yeah.
Earnings per share is actually what it was last year, but they're 40% down or 25% down, very undervalued. It's, you know, that's something that could switch it into a bull market.
Yeah, no, you're spot on. And that's the thing. It's, you know, we go through this derating phase where the market anticipates a slowdown, economic slowdown, recession. We've all heard the words from, you know, not Ben Bernanke, God, that shows my age. He was the old.
Jesus.
I've just gone back to the GFC days. Okay, so let's start again. No, it's not Ben Bernanke. Philip Lowe in the Reserve Bank, talking about recession and obviously coming out of the US. What's the guy's name out of the US? I've just had a mental blank.
Jerome Powell.
Jerome Powell, thank you very much. Yeah, I had Ben Bernanke's name on mine.
JP.
So JP, my mate. Yeah, my mate JP. So, you know, when you look at the talk, obviously the market's factoring, there could be a big slowdown. This is going to be bad. This could be bad. So they sell share prices down. Now, the way that what we call earnings per share works is virtually you take the billions that a company earns and divide it by the amount of shares that are on issue, and that gives you earnings per share. Now, if the price is right, therefore the earnings per share should fall to match the price. But if the market's gone too bearish, and the companies come out saying, no, we're good, we're earning lots of money, and the earnings per share is right, the earnings are right, then therefore the share price is going to come back. So that's right. As you say, there's a number of catalysts. Earnings per share is a big one, especially that guidance that CEOs give. And we've obviously, we're in July now, we've ruled off 30 June, companies will start reporting those results. It's going to be that coalface response. Is it good? Is it bad? Is it indifferent?
Yeah, absolutely. And I mean, again, there are those factors that can act as a precursor when a bear market starts to shift in a bull market. Unfortunately, though, we know we're out of the bull. We don't know we're out of the bear market until after the fact. That is always how it happens. Exactly. The market across a month or two has lifted, 8 or 10%, and you're going, shit, just should have, either put in some more money 3 months ago, or should have, done whatever the strategy was, whatever it might be.
I'll give you a saying that I got told by a very senior fund manager many, many years ago when I first started the industry. And I don't think it's too crude for the podcast, but I do think it's so good. And he said, the only thing you get when you try and pick the bottom is a smelly finger. It's so true. You can never pick the bottom. It's you only know after the fact. No one rings a bell when we're at the peak. No one rings a bell when we're at the bottom. It's just transition through, and you're going, oh well, okay, that was it. But you only know after that fact.
Absolutely. And I was sitting in with a catch-up call with another advisor, and he was just telling me a story about one of his clients, how his client, obviously nervous about market volatility right now, and that's very normal. And the client came to the Australia and said, oh, listen, I've got these funds here, but I don't want to put it in the market right now. I think I'll put it in the market when things are a bit smoother and everything's a bit happier. And then he's like, okay, so when will you know when to put things in the market? Because I don't have a crystal ball. I can read as many earnings stacks as I want, but I won't know. He's like, oh, when, the headlines and media publications, they're a bit more positive. Even when I'm talking to my colleagues and my mates, they're a bit more positive on their own investments. I was like, okay, so when might that be? Oh, I'm not sure. That could be in 2 months. That could be 1 month. That could be 6 months. Okay, so based on your strategy, you would prefer to put in when the market is higher and it's recovered, and then hope to get a good return then, rather than, say, drip feeding into now and then riding it up as we switch into a bull market potentially at the end of the year, whatever it might be. He said, that doesn't sound like a sound strategy. You want to maybe buy high, but you're not willing to buy low when a lot of people are nervous about the market. That's actually when smart investors strike. They take a diversified approach and drip feed in. So it's really interesting having that conversation with them. And it's very common. It's a very common sort of theme right now. I think a lot of retail investors would be nervous about that. But with that in mind, when we look at switching from a bear to a bull, what are some other factors, Brett, do you think sort of could be precursors?
Look, there's quite a few. I mean, some have more, relevance than others. But, when we go through, obviously, there's the economic data we look at. So inflation's peaked. When that inflation number stops growing and it's starting to level out or starts to come down, that's when we know that we're not going to be dealing with this issue and the catalyst of racing rate rises through that period. So once again, as you've eloquently pointed out earlier, we are working on historical data. So very rarely, to me, I don't like using that inflation peak as a catalyst, because to me, normally the market's forward looking. So let's pick an arbitrary number. Let's say inflation's going to peak in October this year, but the market's already priced in what's happening in March next year. So in actual fact, you should have been buying earlier to take into account that
that's right.
And the great analogy, and I've said it many times on the podcast, is when you look at a company that loses $20 billion, and people say, why did it go up 10%? Easy, because the market thought it was going to lose 30. So the market will price in what it prices in. It doesn't wait for the event to happen. It'll anticipate, and then hopefully it's within its close range of what actually transpires. But by the time it happens, it's too late. And that's where this guy you're talking about was going to get it wrong, because the market's, when he's ready, the market's already priced in the next 12 months. So he's going to be paying a premium for the next 12 months, when an actual fact right now.
Yeah. And I mean, that was sort of what this colleague of mine was just, he was discussing with me. He was just talking about the call that he had. I was like, yeah, listen, it makes sense. You can understand it from the client side. We don't know, obviously. We don't have that crystal ball, but getting in when it's already recovered It's not a sound strategy if you're going to be in the market for the next couple of years. Absolutely not.
And that dovetails across onto the next one. Central banks coming off the brakes, when it comes to interest rate rises. So that's intrinsically linked with inflation. Once again, we've seen time and time again, central banks are slower than my grandmother. When driving a car, they will act months and sometimes years after the event in order to, whether they just want that confidence they know it's the right call or not. But I think we've seen Philip Lowe's egg on his face from October last year when markets were saying got to raise rates, and he's lost a lot of credibility. Really, so once again, I don't actually look at it's a nice affirmation when they stop raising rates, because to me that says, okay, great, that just maps up to everything else we're looking at. But I'm not waiting for them to stop raising rates in order to be the signal that you jump in, because the market's already pricing that in.
Too late. Well, that's exactly right. It's already gone. The horse is already gone. It's already bolted. And what's interesting, we're talking. You've mentioned rates, and Jay Powell, my mate, JP, of the US Fed. It's really interesting to see sort of what markets are pricing in for the future in terms of the US Federal Reserve and where they think the US FOMC could go, because there's data out there right now which markets are predicting that at some point, say in the next 3 years, the US Fed will start to turn on its central bank decision and start to head back down. They'll start to reduce rates. So, if it's going to peak and then it's going to reduce rates just to be more accommodative again, then if you're getting in when it starts to decrease rates, you've missed it. You've missed the boat by a long way. You should have been in that market 12 or 18 months prior.
Yep. And that's the thing. We just don't know when it's going to happen. And to me, whether it's 1 month, 3 months, 6 months, because we don't know, it just comes back to ignore the press, ignore JP, ignore Philip Lowe, ignore us, but look at the underlying company that you're looking at, or at the basket of companies that you're considering. Would a General Electric go bust tomorrow? No. Would they, go through that list, that hit list? Telstra, Wesfarmers, ANZ, BHP. On the US side, FedEx, GE, Facebook. The list goes on. All it means is, as long as you think in a rising rate environment that these companies will be profitable, then you are getting them at a discount. Pure and simple.
Absolutely.
What is in the price right now is emotion, and people are nervous, so therefore they're willing to sell at a discount to have the luxury of being out of that. But by giving that away, they're opening up the opportunity for others to get something at a discount, when it was, sort of 3 months ago, sitting 10% higher than it is right now. If it's tech stocks, it's probably 50% higher.
Yeah, absolutely. Tech stocks, I think we've talked about it before. It's one of those specific industries which has taken a big hit. And I guess, precursors and insights you can get as investors, look at the financial data coming out of these companies. Look at if they're ever giving quarterly earnings seasons reports and updates. Look at its earnings and whether it's growing, whether it's shrinking. Obviously, the hard data usually comes out in the half yearlies. And then you'll even note some firms, they come out before their earning results are going to be announced, say, expectations were actually down. Our revenue only grew by 8%, not 12%, and the market is pricing in 12%. So that's why the share price is already at 12% in terms of earnings expectations. So when they release their results, that share price might drop anywhere between, I would say, 3 to 5%, depending on investor sentiment on that day, just to bring it back to fair value. So it's interesting. And earnings season, I mean, it's a good period because it's unemotional, it's hard data. We get an insight into how these companies have actually performed. I believe there's going to be a lot of companies that have actually just soldiered on and done well. They've still had great earnings. Yes, inflation's still going to be there, but I think you'll find that some companies will actually perform really well. There'll be a few jumps in prices trying to pick those companies. Well, that's the hard thing. As long as you're sort of taking a diversified approach, you'll get captured as part of those industry sectors.
And look, I think the overlying commentary is going to be not about growth. It's going to be how do they take advantage of growth with record low unemployment. That to me, that to me is the big one. How do you grow a company? How do you evolve a company? How do you take it from A to B when your headcount is not there to help it? So whether that's from innovation, I don't know how they're going to do it, but that's the bit I'm looking for.
Innovation's an interesting one, and I shot you this on WhatsApp the other day. talking to a client of mine who's works for one of the techs, and one of the biggest themes that's come about from COVID, the work from home theme.
Yep.
And I don't know how they measure this, so precursor, don't know how they measure this, but they said through COVID and this work from home theme, innovation has actually dropped by at least 30% in some of the major tech companies because you can't collaborate from work from home. Real stuff gets done in front of people where, you know, you're in the boardroom together, you're bouncing ideas off you, where you're looking at programs together, whatever it might be. Or they've said, yeah, innovation has actually dropped off. And that's sort of been a side effect, a negative side effect of the work from home theme. So I wonder if we are going to see work from home theme fall away a little bit over the next couple of years as companies look to continue to innovate. I think Elon Musk sent that email to everyone that if you're not in the office and you can't collaborate, then
we'll take it as your resignation.
Hard and fast. I think obviously he's read that report.
Yeah, no, exactly so, Matt. I think we wrap it up there. You know, summarising the call today, there are a number of catalysts that can turn a market from a bear market into a bull market. Don't be too worried about the label of a bear market. Like we talk about, don't be too worried about a technical recession. It's not, you're not going to suddenly go to work one day and see it, you know, blast around everywhere. What you need to look at is the catalysts that change the both the underlying numbers, but also the sentiment, you know, and it's just that narrative. And when you do see that happen, it's too late. So you need to anticipate what's coming down the line. You know, it's if the market's, you know, these catalysts are going to change in December this year, then you need to be buying now. You don't wait till December because by then the market's already priced in the next 12 months.
That's right.
Yeah, it's
forward
all done.
looking.
But mate, I think we leave it there. So thanks very much again, mate, for your expert knowledge, and we'll check on the next episode.
Sounds good, mate. Thanks for dropping in. Speak soon.
Thanks, mate. Take care.